today in this video, we are going to look at how can I start investing in the stock market for beginners. Before we get started, I would just like to make a disclaimer. I am not a financial advisor. This is not financial advice. And before you make any investments, you should contact your personal financial advisor. So with that being said, let's get started. Hey everyone, this is Lauren Mack with Hacking the Rat Race, and I would love for you to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. So before we get into this, there has been a lot of stories in the news about someone named David Portnoy. He's the guy who created Barstool Sports and has recently got into day trading. And he has so many people interested in following day trading. Here's the thing, his net worth is over $100 million. And he started investing with about $3 million. And in the first period of investing, lost almost $1 million before he started figuring out what he was doing and then making money. He also has a large following because of this, of which he's probably making a significant amount of money. So if you're watching this video thinking that day trading is going to be the way to start investing in the stock market as a beginner, that is not what this video is going to be about. And I would even go as far as saying that day trading is very similar to gambling. There are a lot of people that make money and are good at it, but there are a lot of more people who actually lose a lot of money doing that. And even David Portnoy himself said one of the reasons he turned to day trading was because during this crisis, the sports were canceled and there was no sports gambling. So again, if you're looking at how to invest in the stock market, I would suggest looking over the long term. Day trading, while you can make money, can be very, very risky, and I would say is more in line with gambling than investing. So now that we have that out of the way, we're going to look at how to invest in the stock market as a beginner. So basically, there are a couple strategies, and if you're just a beginner and you don't really understand, again, I can't reiterate enough talking to your own financial advisor and coming up with a strategy that works with you, because there are a lot of things that are different for each person that can make your investing strategy a little bit different, which can be your risk tolerance, your retirement horizon, like how many years do you have left until you retire? You know, what kind of money are you making? How much are you looking to invest? All of these things. So I definitely recommend, after watching this, if you are interested in investing in the stock market, then just go and talk to a financial planner to make sure that you are on the right track. So the first thing that I would look at are index funds. And you can get index funds through ETFs or mutual funds. I actually have another video called Index Funds, ETF, Mutual Funds. Which one is the best for becoming a millionaire? I'll link to it above and in the show notes below. But again, that goes into more detail on what an index fund, ETF, and mutual fund are, how they're alike, and how they're different. But index funds are a really good place to start for people who are beginners in the stock market because it is diversified. So for example, the S&P 500, it's the top 500 large cap stocks all into one index fund. So basically you are getting a small, tiny share of each one of those companies when you buy a share of that index fund. The great thing about index funds is they have them for almost every market. International, small cap, large cap, oil, bonds, pretty much REITs, pretty much everything you can think of. And what it does is it just diversifies your risk because you're investing in a lot of different stocks or assets. So basically you don't have all of your eggs in one basket. So if you bought a stock from one company and they did great or bad or an accident happened, then that is very risky with your money. Whereas an index fund, if one company does poorly, well, you still have, for example, with the S&P 500, 499 other companies to fall back on. So the first thing I would do is consider index funds, and you can purchase them through an ETF or a mutual fund, and you can learn more about that in my other video. The next thing is dollar cost averaging. So the way that dollar cost averaging works is you choose an amount you're going to invest every month. So let's just say that's $100. Then each month you buy $100 worth of shares of whatever you've decided to invest in. So if the market's low, then you're going to be buying more shares for that $100. If it shoots up and is high, then you're going to be buying less shares. And overall, you're going to have an average over time. This is a very simple way to invest. If you invest in something like, say, an ETF, then your risk is diversified. And if you're just putting in that $100 each month and buying it at whatever the shares cost, then you're not timing the market, because that is another way people can get burnt. And timing the market means trying to get in at the low point and get out at the high point. Of course, none of us have crystal balls. Even if you analyze documents over and over, things happen, like I mentioned in my other video with Boeing. And again, when those planes that crashed were new and they were rolling off the lot, nobody knew that, again, they were going to a crash, and that all the fleet around the world almost entirely were grounded. So that had a huge impact on their stock. So if you were trying to time the market, that is something that was completely unexpected and would make it very difficult to time the market. And again, it didn't matter how many reports, if you looked at their earnings, their losses, their liquidity, it didn't matter. So if you were only investing in Boeing, that could have had a huge impact on your investment. So with dollar cost averaging, you're not timing the market. You are literally taking the money, putting it in every month, and over time, you will get a benefit of the highs and the lows. So just to recap, you're going to look at getting a more diversified investment, like an index fund or mutual fund, and then you will use dollar cost averaging to purchase those shares over time. And like I said earlier in the video, to really be investing, you need to look at the long-term investment, putting this money in the market and leaving it in the market. Because again, over time, historically, the stock market has been one of the best investments. However, there have been years that it has been amazing and just roared up. And then there have been years where it literally just dropped off a cliff. So if you are investing for the short term, this can be very problematic. So I just highly recommend focusing on the long term, talking to a financial advisor. And if you're thinking, I don't have a financial advisor, I don't even know where to find one. If you open up a brokerage account at places like Charles Schwab, Fidelity, pretty much any of them, most of them will allow you to set up an appointment and talk to a financial advisor. I know for sure at Charles Schwab, again, I have no affiliation with them. I just use them personally and I love them. If you open a brokerage account with them, then you can call and talk to someone for free. You can give them your questions. You can tell them what kind of investing that you're looking at doing. Maybe you can discuss your risk tolerance, and they can help you come up with a plan. Either way, this is a very easy way to invest in the stock market as a beginner that can also really diversify your risk. Thank you so much for watching this video. Don't forget to hit the like button. It literally costs nothing and it does so much for this channel. And don't forget to subscribe so you don't miss any more videos on money, saving, and investing. Thanks so much, and I'll see you in the next video.